Good morning and welcome to my YouTube channel, Ajay Bagga Global Insights. This is the first video I'm doing in English today on the 21st of December 2021. Today, I wanted to discuss one story, one real life story, which is so transformational, which is so inspirational, and which gives so many lessons for us as stock market investors that if you listen to this story and follow one action plan that I want to tell you towards the end of this video, I am sure that you will retire as a very wealthy person with a lot of money and a lot of satisfaction. First, I would like to give some background to this story. I would like to start with talking about a fund called the CGM Focus Fund in the US. This was a top performing fund run by a fund manager called Ken Hebner. Ken Hebner used to run this fund, and in the period 1999 to 2009, this was the top performing US market fund, US stock market fund. This fund gave 18% compounded annually for those 10 years from 1999 to 2009. Why I'm talking about this fund? Because a very interesting experiment was done, which gives a lot of insights to all of us as stock market investors. So Ken Hibner's CGM Focus Equity Fund gave 18% per annum for 10 years. The average competitor was about 15%. So 3% lead he had on the average competitor. But when they went and analyzed the customers' returns, actual mutual fund customers who invested in this fund, they found that customers actually made minus 11% returns. Why did that happen? It is shocking. The fund is giving you 18%. The customers got it right in terms of going to a top performing fund, which performed very well for 10 years. They got that decision right. They got the decision of investing in that fund right. How did they end up with minus 11%? It's the behavioral problem. It's the emotional problem where all of us tend to run out of the markets at every fall and get into the markets when there is a lot of froth. So whenever the fund is really outperforming, you go ahead and buy. And whenever the fund is underperforming or the fund has been going down or the underlying market is going down, we would go and sell. So customers were actually doing the reverse of the success formula of buy low, sell high. They were actually buying high and selling low and ended up making, on average, the investors in that fund made minus 11%, even though the fund returned 18%. Very stark example. No, you can say this is one-off example. We have to study in depth what happened exactly. The dot-com crash also happened during that time. So maybe customers went out because of that. We'll have to check a lot of other things. Very true. I agree with you. A lot of global events happened. 9/11 also happened during that time period. But let's take another study, which has been running for 40 years by a firm called Dalbar, DALBAR. They take out an annual study of what markets are returning, US markets, what the average actively managed large cap US mutual fund is returning, and the returns that US investors are making. And you know what they found? If the market was giving 11% for a decade, the average fund was giving about 6.5 to 7%. 2% went off in the fund fees. 2% was underperformance by the worst performing funds. So even though the top performing quartile of funds would have beaten the benchmark, but because there were so many underperformers, the average fund was making 3 to 4% less than the market. But the investors were making just 4%. Again, the reason was whenever the markets were tanking, the investors were rushing to the exits instead of buying more. And whenever the markets were frothy, markets were looking up, that time they were buying more and more. So buying high and selling low, recipe for disaster for your portfolios. This is the background I wanted to give you. One more thing, what is happening in India right now? You know, up to last year, we used to see 4 lakh demat accounts opened every month. This year, from January to now, every month on average, 26 lakh demat accounts are being opened. Partly it is because of the IPO mania, where IPO oversubscriptions have led to huge gains. So a lot of people want that demat accounts to be opened. Partly also it is what is called globally as Robinhood trading. In India, you can say it is the discount brokerage trading, where new investors are coming in and becoming stock market traders. That's a very good phenomena. India is very underpenetrated in terms of participation in the stock market. Only 7% Indians participate in the stock market. Less than 6.5, 7% of the household's wealth is invested in the stock markets. So it's a good move. US is at 50%, Japan is at 40%. So it's a good move. It's a function of maturity of the markets that if people start investing in the stock market. What is not right is that a lot of these new investors are traders. And I will take one more video on another day on this, why trading is hazardous for your financial well-being. Trading has a lot of costs. Nobody gets timing right. We have a lot of information, lot of free technical analysis software available, lot of formulas available, but very few technical analysts are really millionaires, while you have billionaires in the investor category. Why do George Soros, Warren Buffett, Charlie Munger, all these are billionaires by investments? While the traders, you will rarely struggle to find more than 20 famous traders globally who have made a lot of money in trading. So 95% of retail investors end up losing money in trading in this fast buy, buy, sell. It doesn't really work. But still, it gives you a high. It impacts the part of the brain which is addictive, which reacts to a lot of other addictive substances, and trading is seen to work on that part. So it's a part that satisfies the gambling instincts also, but trading is very hazardous to your financial well-being. And that brings me to the story of today. The story is of the coffee can investor. He was the inventor, Robert Kirby. In 1984, he brought in the term coffee can investment. This was basically to hold quality stuff, and proverbially, like our mothers would have a piggy bank, a bugni, where you would just keep putting money away. Either, you're worshipping God and every day you would take out some money and put it in God's store, or you would be saving for a rainy day. So you would have a small coffee can in which you would just hide the money and then hide it away in a clothes cupboard or lock it up in your Godrej. In the olden days, we used to have that. So this coffee can investing term came from that only, of putting away some treasure in a coffee can and hiding it away for a rainy day for a long time. Robert Kirby invented this coffee can investing you know process, and he was the first to use it in 1984. In 2000, he wrote a very interesting article about a customer of his. He used to run an advisory service, and that is the story I want to share with you, along with a true life experience of mine. Some of you have written on my timeline asking for that experience. I wanted to share that with you today. So, Robert Kirby said he had a lady investor. So, as part of his advisory, he would tell her that, okay, buy this. And then at the right time, as he thought, based on his timing, he would say, now you can sell this, book your gains, book your losses, go to this stock. So all was going well. Lady was very happy. She was making good returns from Kirby's advisory letter. After about 10 years, the lady's husband, who was a very wealthy lawyer, so he was a well-known, prominent lawyer, he passed away with a heart attack. And when the lady opened his safe, his vault, she found a lot of stocks lying there. Those were not the days of demat, so physical certificates would be there. So she was mystified. She didn't know that her husband was a stock market investor. He used to manage her stocks also. So she went to Kirby. She found his address and went to Kirby. Can you help me out? My husband is no more. And I found these stocks. This is my statement which you have been managing. And these are the stocks which are in his name that I found in his safe deposit vault in his office. So Kirby said, okay, leave it with me. On the weekend, he sat down. He had the lady's statement and then he started seeing the husband's stocks. He put them in a chronological order. And guess what? He started laughing. As happens to all of us, somebody takes a PMS service or takes an advisory service, and then a family member uses the same buy sell, uses the same advice free of cost on the sly. So he realized that the husband had been buying the stocks based on what he was recommending to the wife under his advisory. He said, no problem. I was getting my full payment from the wife. Then he found another intriguing thing. He saw all the stocks that the wife had bought were all lying in the husband's portfolios, but he had never sold. Even though he was managing the wife's account, so he had the information that Robert Kirby, Coffe Can Investor, is now saying, please sell it. And he was not selling. He was just filling it, shutting it, and forgetting it. He just left it in his safe to lie, trusting Kirby's judgment in stock picking. What happened? Kirby then made a mark to market. He made a list of what does it all add up to, and he was shocked. A lot of those, the husband was putting $5,000 in every buy call of Kirby over these 10 years. A lot of that $5,000 companies had gone to $100. Some had gone to $2,000. So huge erosion of wealth. Some were at 5,000 still. There were about 10 companies which were more than $100,000. So they were 20 baggers. Kirby was very happy that he picked up. Company had gone up 20 times in 10 years' time. That was a great thing. And he found one company which astounded him. Even he had not realized, because he had given a sell call on that company long back when his customers were in the profit. One company, $5,000 had become $800,000. So 800 by 5, you see how much it comes to. It was a 160 bagger. 160 times the money of the client had been appreciated in 10 years in that company. Which was that company? I'm sure you are all very keen to know which is the company. It was called Haloid at that time, Haloid. Eventually, it became the documents company Xerox, whom we know as photocopying, and actual photocopying became a generic brand as Xerox. It was such a powerful company. So Haloid, a predecessor of Xerox, was this company, which was a 160 bagger. This is an article written by Robert Kirby in the Journal of Portfolio Management in 2000. I've read that original article. Maybe someday we'll go deeper into the learnings from that article. Why I wanted to give you this example, that one stock which went from 5,000 to 800,000, 5,000 becoming 8 lakh, that one stock was greater than the portfolio of the lady, even though the same amount of money was being invested by the husband, both in his wife's name and in his own name through Kirby's service. But he had a different perspective. The husband was just buying and holding forever. The wife was following Kirby's timing signals and selling whenever needed. That one stock was greater than the wife's entire portfolio. This is the power of compounding. If you get lucky, it can really create huge wealth for you. We will talk subsequently about coffee can investing, some Indian examples I'll take up in the next few weeks. Today, I wanted to request you one action item. I have seen that in my life. We were youngsters working in Citibank in the early 90s. There was an IT company of Citibank, a subsidiary, which used to service in-house and then it went out servicing some more clients. We were given stock options or stock grants rather in this company. My holding in that company today is worth 80 paisa is my cost of holding of that company, which the bank granted us. A lot of my batchmates, a lot of my friends, colleagues really benefited from this company. Eventually, Citibank sold it out. They listed it first as iFlex. Then Oracle went ahead and Oracle bought out this company. It is called Oracle Financial Services, OFSS. You would have seen. Now, if which is listed in India, that 80 paisa share is today worth about 4,000. It went as high as 4,600 rupees also recently. So it is about a 4,000 bagger or 4,500. If you do the math at 80 paisa, you will probably get to a 5,000 bagger. And the company also gives you a very good dividend, nearly 150 to 200 rupees of dividend it gives you every day. Again, I'm not telling you to buy Oracle. This story will not be repeated. It's a once in a lifetime. It happened to a lot of my friends working in Citibank with me. It created serious wealth. I know one country head who bought a house in Cuff Parade in Mumbai for multiple crores by just selling these stocks. I have a lot of friends around the world who still own that stock and get hefty dividends every year. This is the kind of story that can happen in your lives. It's not that I'm a very successful investor. I pick up only these. I have a few of these companies in my portfolio, but I have made my own set of mistakes down the line where the companies don't exist, where the promoters ran away with the money. We don't talk about all that. But my big message to you is this is a possibility. Look at the positives. The negatives are frequent trading, having very high costs, paying commissions, paying taxes, going on changing your portfolio, trying to time the market when statistically we are proving again and again that no one gets the timing in the market right. I'm saying don't focus on those negatives. Jason Zweig of Wall Street Journal wrote a very nice comment a few years back. He says, option trading allowed me to put two children through Harvard. So option trading allowed me to fund two children's education in Harvard. So you're very impressed, okay? He made a lot of money. What is he saying? And below he writes, unfortunately, they were the children of my stockbroker. So because of the commissions he was incurring, he's saying it's a tongue-in-cheek joke. Basically, he's saying frequent trading only enriches your broker, only enriches the government in terms of taxes you are paying. It does not add much value to your portfolio, but buying and holding quality stocks really adds huge value. And that is the action item I want to request you today towards the end of this video. Identify 10 stocks. The constraint I am putting on you is as follows. Take a small amount of your portfolio. You know, suppose You can afford 10,000 rupees today and you will not miss it. Maybe 10,000 rupees, maybe 1 lakh rupees, whatever is comfortable for you. It's a very long period experiment, so don't put too much money into it. Take 10 stocks. The constraint is they must be in the top 100 companies by market capital. They should be all be from a different business house, so not from the same business house. They should be from a different sector. So don't buy 5 banks and 5 IT and be through with it. Buy, say, 2 banks at the most, 2 IT companies at the most, 2 top pharma companies. So they must be in the top 100 companies in the stock market. So NSE 100, BSE 100, you can see the list. You are not allowed to invest more than 1/10 of the capital which you have put aside. So if you have said decided I'm going to put a lakh of rupees, 10,000 rupees is what you can buy max. You're not allowed to touch this for the next 10 years. That's why it is most important that you buy the highest quality company which has a good probability of survival for the next 10 years. So you can't buy more than 10% of this portfolio that you have set aside. And it's a forever portfolio, so you will not look at it for 10 years. You can do a mark to market, but you are not allowed to sell it for the next 10 years. Let's watch how this works. I wish you all the best. It has worked very well for me. Holding quality companies, I'm holding so many companies at a fraction of their cost today, and I make more in dividends today than my original cost. It is not necessary that you have to follow that path only. There are many paths, like there are many paths to God, there are many paths to financial success. You find your own path, but this will work. This I can tell you very confidently. If I live for 10 more years, we will revisit it. Share with me your portfolio, your 10 companies which you chose. Say the top 1 or 2 IT companies, top 1 or 2 banks, top one oil and gas major conglomerate, top one chemical company, top one paints company, top 1 or 2 auto company, top 1 or 2 real estate company, top one industrial company, top one metal company. Choose like that. They should be market leaders. They should be in the top 100. Uh, they should be profit making. Don't look at special situation kind of a thing. And you should have a gut feel that they will survive for the next 10 years. FMCG, consumer durable, industrial. So take a wide swath, 10 companies, 10 years, 1/10 of a small portion of your portfolio. Let's take that challenge today. Share with me. I'll keep a note uh, of who's invested where, and we will compare notes once a year. I have one more very interesting story on Warren Buffett. Maybe later in this week, I'll share that with you of how this long term investment and long term compounding works. All the very best. Thank you for listening to this video. And if possible, please subscribe to this channel so that you get all the new video alerts whenever I release a new video. All the very best. Wish you a very happy new year. And thank you once more.